Hi, it's Jeffrey Cohen, Chicago Quantum. It's May 13th, Friday. This market is going up dramatically. Dramatically in the middle of a stock market crash or stock market correction. This is a very, very odd Friday in the markets. There is speculative frenzy, and we heard about it yesterday. We had some people reach out to us and say, hey, Friday's going to be a big day. I'm noticing some data that I can share with you. And I want to point out a concept called the Dow theory. It's from like 100 years ago. Dow Jones is based on the success of that theory. And so I got to tell you, it's a weird day in the markets, right? So markets are up. First off, let me show you that the markets are up. And then let me show you what stocks or what industry sectors, what parts of the market are doing really well, so that you can think about, if you have a day where you believe the market's going up, how can you make the most money? On a day like today, the money's probably already been made, and the markets are probably going to fade into close, but lots of stocks went up 10, 20% today. Let's dig in. So, you're listening. I'm Jeffrey Cohen. I'm an investment advisor representative with U.S. Advanced Computing Infrastructures Incorporated. We are an Illinois registered investment advisor. We don't invest your retail money. We provide quantitative models. We provide smart volatility models, momentum-based models, Sharpe ratio-based models. We look at variance. We look at volume plays, money flows. We look at ups and downs, and we help large money managers manage their risk versus return of their investments. So that's our context. That's what we do, and we are in this market, all day. So if we look at the S&P 500 today, this is Finviz. By the way, thank you, Finviz. Great. If you want to go to this site, you just type in Finviz in your browser. I'll show you how to do that, just so you could do this yourself. Just type in finviz.com. There you go. Click on this. 1 day S&P 500. So it might not be okay just to look at the S&P. Maybe we got to look. So first off, Tesla's up, Amazon, Google, Facebook, Apple, Microsoft, Visa, MasterCard, American Express, Berkshire Hathaway, your oil companies, ExxonMobil, Chevron, you name it, GE, they're up today. The railroads, the home improvement companies. It's like a full-on rally. When you hit the full button, what happens is you don't just get the S&P 500, but you get smaller cap companies too. And so you see much of the market is green. Telecom is a little red. Healthcare is a little red. Regional banks are a little red. So, but the market's pretty green, pretty widespread. So that's helpful. The second thing I like to do, I like to go to the main Finviz homepage and just see this pretty chart. So you can see the Dow started down, popped up. NASDAQ's just been up all day. S&P up all day. And now into the lunch hour, where normally we see a correction during the day, we see actually the market just jumping up even more. And so, just to point out major news, Coinbase, right? You can trade crypto there. Robinhood, new people who invest in the market, who trade the market, use that. You see big movements there. And so that tells me we probably ought to look at crypto and see how crypto's doing. I like Finviz's visuals on crypto because they show it on the dollar, but also against the euro. So Bitcoin is flat today at 30,400, and it's a little bit mixed across the coin. I was expecting to see Bitcoin's up a lot because the stocks were up, but we'll take a look. What else do we have lined up for you? The futures box. So you see the VIX is down a little. It's under 30. So what this tells me is people are forgetting their fear today. Feeling good today. By the way, oil, $110 a barrel. Wow. Bond yields, the bonds themselves are cheaper. The yields are up. So bonds are cheaper. So the interest they're paying is higher. So your mortgages are going up. Your loan costs are going up. Gold's down, silver's up. It's an odd day today. The dollar's down, which is good for the market. It's very bullish today. The Russell's up 3.5%. The Nasdaq is up more than 3.5%. The S&P's up 2.5%. This is very bullish activity. And so the question is, why is it happening? And where? More importantly, because why is a tough thing to answer. Where is it happening? So I was just looking at some garbage stock, right, which is actually down a lot and continues to be down. Let's take a look at the money managers. Let's go sector by sector that we follow. By the way, why are we wearing sunglasses? Because this market is so hot, it's burning our eyes. I'm wearing a red shirt because we are in a correction. Money managers are universally green. Every money manager that we track in our index is up, including the ones that are losing money and having a terrible time. Let's take a look at chips and semiconductors, because those are your canary in a coal mine. Oh, they are 100% higher today. Quantum computing companies. Those guys have been hitting new lows lately. 100% higher. Trucking and transportation and logistics. 100% higher. Wow. Specialty retail. These are the places you go where things are a little bit more expensive. Now, what's interesting is a company that we like, Flex Steel, they make furniture very high quality in the United States. They're down. Walmart and Dollar General are down, but all your specialty retailers are up, and up pretty significantly, including the cannabis specialty retailers. They don't sell cannabis, they sell the stuff to grow the cannabis. So an ultimate substitute good. Cannabis is about 5 times cheaper if you buy it cultivated outside. Supposedly it's lower quality, but it's like 20% of the price, right? Wholesale price. So if you're into cannabis, you can get a whole pound of it for like $400 or $500 wholesale if it's grown outside. It's $1,600 or more if it's grown indoors in a greenhouse. And so much more expensive. These guys, Grow Generation and Hydrofarm, help people to grow it indoors effectively with hydroponics. So now I'm going to show you something a little crazy. These are the current holdings as picked by our model. Not current holdings. Current efficient portfolio. These are stocks that were picked by our model yesterday, day before. You wanted to be long these stocks if you thought the market was going up. They range from 2.5% up to 28% up. The median is about 11% increase today against an S&P 500 of 2.5. So that's about 4 times the return of the market. This is a dramatically positive place. So if you had us run your money, or if you used our model to run your money, you would have almost a year's worth of earnings in one day. Your large portfolio, which at this point has a lot more stocks in it, same thing. 2.5 to 28% rise. The median increase is about 11%, 11.1. So, yeah, you would have made a ton of money today. 4 times the S&P 500 rise with significantly lower risk than the S&P. This is where you want to be. You want to be in our efficient portfolio, or CQNS UP run. Now, we track an index which we call a bad name. We call them stonks, right? And stonks are stocks that are down. They're dogs. They have trouble. They're troubled stocks, right? They're down, they're down, they're down. They're in trouble. They have issues. They have restructuring issues. They have memeing issues. 2 of them are down today. The rest are up. The rest are up a lot, actually. And so after we would have told you to short these and you would have shorted them, today was the day where they boosted up. So what's going on today? What happened that all this money is coming into the market? And so I want to show you something. Now, the funny part is while we're having this discussion, who knows what the market's going to do? We're going to keep it up here. Let me make it much smaller. Let me show you some data, right? We produce this data. We love this data, okay? First thing I want to show you is in order to run an efficient portfolio, our model gives you portfolios between 7 and 18 stocks that have a 5 times 10 to the negative 4 edge on the market. The market is set to 0. So anything negative is better. And so you have a choice here, depending on what types of sectors you want exposure to, how many stocks you want, how many stocks you feel comfortable holding, researching, and trading. You could have gotten 7 stocks or 8. 8 was the best. Or as many as 18. And so this is a great way to manage money, right? Especially holding on when those markets go up. And maybe hedging when markets go down. Maybe having a hedge, a short hedge, right? This is great. This is what we do for a living. We produce it. It works. First couple things I wanted to show you was the risk of money-losing stocks, the variance of money-losing stocks as of yesterday. Oh, by the way, we increased our number of stocks. We set our market cap limit to $300 million equity market cap. Your risk of holding all of the money losers, all of them, equally. How many of them are there? Oh, there's 800 of them. 796 was 4 times 10 to the negative 4. So that number may not mean anything to you, but it means a lot to us because that number's high. So, money-losing stocks, variance. Over the past year, equally held 800 stocks. Okay, that's interesting. That number's been like 3.5, 3.7. That number is higher. It leapt higher yesterday. Money-making stocks, companies that made money, let's take a look at that number. That's 1.4. So what matters is that money-making stocks had roughly 1/3 the variance of money-losing stocks. This market is punishing money-losing stocks. Okay, Jeff, that's fine. What else can you tell me? So, 800 money-losing stocks. 800 of them. Closing price average, 67.5. So, average loss for the 253-day simple moving average, 32.5%. Your average stock is down 32.5%. And your volume versus the 253-day simple moving average, it's up 66%. So yesterday, the average money-losing stock traded 66%, or 2/3, more shares than it did a year ago. Volume's up. People were betting on that market yesterday without telling you. I'm sure when you went on Twitter, everyone was saying, hey, we're buying up all these money-losing stocks, and we're going to wait because Friday we're going to make a ton of money. We're going to blow it out. I don't remember reading that on Twitter or getting any phone calls about that because no one's telling you. Variance. Oh, I'm not going to look at that. That's too complicated. By the way, we fixed our variance math. Woo, woo, woo. Our variance is now perfect. We fixed it. Yay. We just got tired of looking at it where it wasn't quite right, and so we fixed it. So, average price for money-making stocks, it's down 11.4%. So this is the 253-day simple moving average price change for positive net income stocks. It's down 11.3%. You're going to see that's different than what we see for the money losers. Your last day volume versus average is up 39%. So we're going to talk about what this means. So I'm showing you that this is real data that came out of a spreadsheet that was produced by our model. It's not played around with. So money-losing stocks have higher variance as of last night market close. On average, money-losing stocks are down 32.5%. So if your portfolio is down 32.5%, don't feel bad. You're at the average. And your volume yesterday was up 66%. So what that tells me is people were trading very aggressively in money-losing stocks. It's hard to manipulate this number because you're comparing it to the average volume of all these stocks, 800 of them, over the past year. So we look at the variance of the positive net income stocks, it's 1.4, so it's about a third. 3-to-1 variance if you invest in dogs that lose money. Your 253-day price change, you're down 11% if you invest in money-making stocks. And your volume change is 39% as opposed to 66%. Your loss is 11.3% versus 32.5%. So my takeaway on this is market action is concentrated in stocks of companies that lose money. And I'm not sure why that would be, because I think about like what my grandfather would have told me. Jeff, put your money invested in money-making companies that pay a dividend, Jeff. Get into the good companies, the solid companies. Remember the movie Wall Street? Oh my God, that old guy. Buy the dividends, buy the good stocks, right? But that's not what's happening today. Today, the market action is concentrated in the garbage, right? In the stonks, in the companies that lose money. And I bet you, if I were to go to Yahoo Finance, screeners, and I were to look at daily gainers versus daily losers. I'm not going to use our own saved screener. This is screeners that you would have access to today. Then your losers today actually didn't lose that much, down 11%. So you lost on Twitter because Elon Musk has put the acquisition on hold. You lost on Rogers Communication. I know they just swung to a loss. So that makes sense that they're kind of readjusting from being a money maker to a money loser. And there's some other ones in here. There's nothing that exciting for me right now to talk about other than Twitter and Rogers Communications. We look at what's gone up, 38%, triple the growth. The good news is there's a lot of companies that our model picked last night, and there's a lot of companies that our model's been picking all week. So I'm happy about that. But that's not the point. So Lightspeed up 28% was one of ours. Silvergate up 25%, one of ours. Sure, there's a few more in there. But these are companies up. I'm just trying to find anything that kind of makes the point. So Robinhood. Robinhood was downtrodden money loser. It's up 24%. Beyond Meat, a dog, is up today. And maybe it's short covering. Maybe this is the day when people are squeezing the shorts. Stone and Company Oh my God, that's a name we haven't seen. WeWork. HubSpot. You know, what's interesting is the real dogs who are down 80-90% aren't the... Oh, Upstart. By the way, we love Upstart. Not sure we love it at this price, but we love Upstart. Roblox, my kid likes it. Roblox is up a lot today. So these are stocks that have been pounded down. DoorDash, big names, but they're up a lot. And so I believe what's happening is there's money being flowed into the market. It's probably already out because a lot of the names... Oh, Trade Desk is one of ours. Efficient Stock Holding, up 14%. Really nice. Bumble's one of ours, up 14%. So our efficient portfolio picks... If you're a money manager watching this, you probably want to call us. Now, I'm not putting my money to work on this, but I could put, if you had investor money and you wanted an efficient portfolio run, we can help you do that. That'd actually be really cool. We do something a little different than everybody else because we built this algorithm to run on a quantum computer. That's why we're Chicago Quantum. We spent a year developing a quantum algorithm. We can now, and we do now run it on regular computers, classical computers, but it was designed differently. And so, Zim, up 8%. That was one of ours. Just lots of stocks that are up. And so, what I would say is this. You're in a down market. You're having a great day. Look at the NASDAQ up 4%. The Russell's up 3.7%. Your money is probably worth more today. The S&P 500 up 2.6% today. But if I can remind you about why the market has been falling, let me do that. And all of this fancy, finding an edge in the market and looking at volumes and looking at moving averages and all of that, put all that aside for a minute. Why is the market down? Let me just remind you, okay? And I'm going to focus more so you can see me, okay? Let me give you the big reasons. The first reason the market is down is we are more than likely heading into a recession. And in a recession, more companies lose money. As companies lose money, the price of the company's stock goes down so that future expected returns go up. That's great. But if you're holding the stock now, the price goes down. If you are a CEO or an executive and you're paid on stock price, you don't want to be losing money. So we're going to see layoffs, and we're going to see recessionary actions. We're going to see cutbacks. And that's going to be very painful for our economy, number one. Number two, interest rates are rising. They are. Inflation's at 8-9%. Wholesale inflation was over 10%. Interest rates are going up. According to the Dow theory, interest rates going up means stocks go down. It's what it is. It's not hard. It's not technical. It's not even that complicated. If I could earn 6% in the bank, I'm going to put my money in the bank. By the way, if I have to pay 14% for a mortgage, 10% for a mortgage, I'm not going to buy very much house. Or I may not even buy a house. I might live in an apartment. Or I might stay in my old house. Then Home Depot doesn't sell you new appliances. And guys don't come out to fix the new house up. Okay? Number three. First is recession risk. Second is interest rates going up. Let's talk about the third thing. Liquidity is down. Liquidity is the amount of money that's focused on the stock market. Buyers and sellers. Okay? For an orderly market, you want to have as much money back in the buyers as back in the sellers. That's nice. Because then if you want to trade 100 shares, it doesn't change the price of the stock. Or 1,000 shares. There's a stock that I own that's like $2.50 a share. Do you know if I were to try to buy 10,000 shares, putting $25,000 to work, I'd probably move the price of that stock up 1, 2, 3%. Now, if I'm a money manager and I said, Jeff, I really love that stock and I want to buy 1,000,000 shares, my guess is it doubles the price of the stock. You can't put $2.5 million to work. Most money managers that I know have billions to invest. So when a buying or selling of a stock changes the price so much, that's called a loss of liquidity. It is caused by less money floating around directed at the stock market to do buys and sells. That's why we see big candles. You see big price changes every day. I'm going to pull up. Well, it doesn't matter. I don't want you to see it. You're not going to see it. But the point is, there's a lot of swings, right? Big swings. So the next thing is the Federal Reserve is looking at changing the amount of money that's in circulation. So today, there's a certain amount of money. It's like $27 trillion in what they call M2. M2 is fast money, cash, immediate deposits, with some slightly slower money. Now, the reality is it's fast, it's slow, it's okay, right? There's a lot of money out there. And so what I would say is when we see the amount of money going down, it makes stocks go down because there's less money to invest in the stock market and there'll be more money needed in other places. And so I guess what I'll say to you is this: there is a groundswell of things that are going wrong with stock market investing right now. And I just want you to be very, very careful out there. If you're the type of person who can be in and out in a day, that's great. If you see the stock market go up 4% during a confirmed decline, you might just want to watch and stay out of it. So I want to thank you for watching. This is Jeffrey Cohen. If this was useful to you, that's great. If you liked the video, by the way, if you like the hat, the sunglasses, I love it. I'm trying to lighten it up a little for you. Leave a comment below. It really helps us. Tell us you like the video. Tell us you don't like the video. Give us any issues. Talk about what you'd like to talk about. I can do it in the next video. And hit the red subscribe button. That really helps us. We don't get paid for making these videos. Not at all. Not even a penny. We make them so that we're sharing with you our insights, which makes us smarter. We do it to help you, but we also do it just because we think giving back is important, right? So take care. Have a great day in the markets. Be safe out there. Bye-bye now.